There are a number of ways to value a business. The appropriate valuation method depends on various factors such as the nature of the business, the industry trends, and the available financial information for that business. Now in this video, I'll talk about some commonly used methods to value or appraise a business. But before we start any valuation or appraisal, we need to do a little, preparation work. The first step to valuing a business is to gather all the necessary information. This information includes the business's financial statements. Now that includes balance sheets, income statements, and cash flow statements. You'll need to gather information about the business's assets, liabilities, and equity. It's essential to ensure that all the financial statements are up to date and, of course, accurate. Now, other factors to consider include the industry in which the business operates, the current economic climate, and any legal or regulatory issues that may affect the business's leases, staffing levels, products or services, supply chains, etc. In other words, you need to gather enough information so that you have a complete understanding of what the business does, how the business does it, who the business does it to, and how much money the business actually makes. Now, we'll start with the earnings multiplier method, as this is probably the most common way of valuing a small business here in New Zealand, and it involves comparing the business's financial performance to other similar businesses in the same industry. And then it applies a multiple to that financial metric, such as EBITDA, that's earnings before interest, taxes, depreciation and amortization, or revenue or turnover, whatever. The multiple is derived from industry benchmarks or recent transactions and is multiplied by the target company's corresponding financial metric to establish the value. So in other words, it might be a multiple times the profit equals the value. Now, to use this method, you'll need to identify comparable businesses and calculate their multiples. You then apply those multiples, those averages, to the business you are valuing to determine its value. Now, the discounted cash flow or DCF analysis. This estimates the value of a business by calculating the present value of its expected future cash flows. It involves forecasting future cash flows, selecting an appropriate discount rate, reflecting the risk and opportunity cost of capital, etc., and then discounting the cash flows back to their present value. Now, this discounting rate takes into account the risk associated with investing in that type of business. Now, once you've estimated the future cash flows and determined the discount rate, you can calculate the present value of those cash flows. Now, this represents value in today's market or today's business value. Now, changes in interest rates can affect the discount rate used in the DCF method, and changes in industry or economic climate, government regulations, etc., can affect the business's future cash flows, as can, legal or other regulatory changes, I guess. Now, the market capitalization method values a publicly traded company based on its current stock price multiplied by the number of outstanding shares. It reflects the company's total market value as perceived by the stock market. By using a comparative company analysis, a CCA, a comparison is made with the target company to similar publicly traded companies by analysing those key financial ratios, price to earnings, price to sales, or price to book value, etc. The target company's valuation is derived by then applying the averages or mean ratios of comparable sized companies to those companies' financial metrics. Now, there's also the asset-based valuation, and this method calculates the value of a business by summing up the fair market value of its assets. It can be done as a going concern basis, where the assets are valued based on their ability to generate future income, or on a liquidation basis, where the assets are valued based on the estimated selling prices in a liquidation scenario. There are also industry-specific methods. Now, certain industries have unique valuation methods tailored to their own characteristics. For example, commercial property often uses cap rates or capitalization rates or net operating income to value a property business. Now, it is important to note that valuation is both, the science and a little bit of an art. And different methods may yield different results. Any valuation should consider a combination of these methods and exercise judgment to arrive at a reasonable valuation of the business that you're looking at. Now, there is also the difference between an appraisal of value and a valuation of a business. Now, to understand this difference, have a look at this video up here. I'll see you over there. Thanks for watching. See you again.